If you've been following the financial news, you know that our elected government officials are discussing the debt ceiling and working on ways to come together to avoid a default. I'm Winnie Sun, an award winning financial advisor and managing partner of Sun Group Wealth Partners, and today we're going to talk about the U.S. government's debt default crisis. First, it's important to share that to date, the United States has never defaulted on its debt specifically due to the failure of raising its debt ceiling. We need to distinguish that there have been instances in U.S. history where the U.S. has missed debt payments, but these were unrelated to the debt ceiling. The Treasury Department has confirmed that it has enough cash to fulfill its current obligations, but a decision regarding the debt ceiling must be reached by June 1st, 2023. Months prior, in January of 2023, the U.S. reached its debt ceiling, but immediate default was avoided through the implementation of what they call extraordinary measures by the U.S. Treasury Department. Therefore, it's very important for Congress to take necessary action, such as suspending spending or raising the debt ceiling to prevent a potential default on the nation's debt. If Congress doesn't raise the debt ceiling by June, the government will be forced to default on its debt. This would be a devastating impact on the economy as it would lead to a loss of confidence in the U.S. financial system and trigger and bring us closer to a global recession, and many Americans would financially suffer. Let's take a look at the reasons to keep faith, though, for now. There are a number of reasons why the United States is unlikely to default on its debt. Well, first, the U.S. government has a very strong track record of paying its debts. And second, the US economy is still great and strong, which makes it unlikely the government would be unable to meet its financial obligations. And third, the US Treasury Department still has a number of tools at its disposal to manage its debt, such as selling Treasury bonds. However, there is also a number of risks that could lead to a U.S. debt default. The U.S. economy could experience a severe recession, which would make it difficult for the government to raise the revenue it needs to pay its debts. Now, second, Congress could fail to raise the debt ceiling, which we know is why President Biden and House Speaker McCarthy continue to negotiate at the moment this week, which would force the government to default on its debt. And third, there could be a continued loss of confidence in the U.S. financial system, which would in the future make it even harder for the government to borrow money. So let's discuss this. If the United States were to default on its debt, what would be the negative consequences? Well, first, as we discussed, it would certainly lead to a loss of confidence in the U.S. financial system, which could trigger a global recession. Second, it would make it more difficult for the U.S. government to borrow money, issue bonds, which would increase the cost of financing the government's operations. And third, and this is a big one, it could lead to a decline in the value of the US dollar, which would make imports more expensive and exports less competitive. This would greatly impact us Americans as we're dealing with still high levels of inflation. So, what can the average investor do? Well, first, talk to us, your financial advisors. Seek professional advice. You want to consult a financial advisor who can provide tailored guidance for your specific financial situation and help you navigate the potential impact of a debt default. Second, review your portfolio with us. Take a look at your holdings in your portfolio and evaluate their sensitivity to a potential debt default. Consider reallocating assets to more stable investments or those less impacted by the default. Now, if your time horizon is long, you should also talk to us about investing more when the markets get negatively impacted, offering you opportunities to invest at dips. Third, diversify investments. Spread investments across different asset classes, sectors, and geographical regions. Diversification can help you mitigate risk and reduce your exposure to any single investment. For example, if you have too much in your company's stock, pay attention, or a country affected by the default. Fourth, maintain cash reserves. This means your day-to-day funds, as well as your emergency funds. Hold enough cash reserves to meet your household's immediate needs, especially during uncertain times. Cash can provide stability and liquidity during market volatility. and it's not just cash. You want to talk to us about a money market, FDIC insured short term CTs, and more. And right now is a great time to reduce your expenses, increase your savings, and balance your budget. Stay close and stay informed. Stay updated on the latest news and developments surrounding the debt default situation. Read our newsletters, watch our videos, share our articles, and reach out when you have questions. You'll want to monitor market conditions, economic indicators, and listen in to government announcements to make informed investment decisions. Next, avoid dramatic moves. Avoid making impulsive investment decisions based on short term market fluctuations or speculation. I want to repeat that again. You want to avoid making impulsive investment decisions. Panic selling is dangerous to your portfolio, and selling during a crisis can often lead to losses. You'll want to stay focused on long term financial goals and maintain a disciplined approach. After all, even with the headlines, you will still need to plan for those important long term financial goals like retirement and more. Next, double check your fixed income investments. Review fixed income holdings such as bonds, particularly those directly affected by the default. Understand the potential impact on interest rates, credit ratings, and the ability to receive timely payments. 8. Consider and re review your diversification. Consider investing in safe haven assets like U.S. Treasury bonds, excluding those affected by the default, or other investment assets which are typically seen as less vulnerable during times of financial uncertainty. Lastly, stay calm and carry on investing. Maintain a long term perspective and avoid making hasty decisions driven by fear or uncertainty. Markets can experience volatility during challenging times, but as all investors know, they also have a history of recovery. Thank you for tuning in. I appreciate you taking the time to learn more about our current debt ceiling conditions. If you have any further questions, please feel free to reach out. Thank you and be well.